let's jump over to our man Kevin Hincks. We'll talk to him about some of the action we have going on. And folks, you can check out Fast Market every trading day right here on Tiger TV, 12 noon Eastern time. Your host, Kevin Hincks, Tom White, the whole team at TD Ameritrade Network. They got some great guests over there. They break down the day's market action, walk you through hypothetical trade setups. Kevin Hincks, what do you think of the jobs number this morning, man?
Good morning, Tommy O'Brien. You know, it's interesting. It's a lot of what we thought it might be, but certainly stronger than expected, Tommy. When you look at the ADP number, 235,000 jobs, almost double a month ago and much higher, about 90,000 jobs higher than the consensus was of 145,000. That changes some of the outlook for tomorrow's non-farm payroll number, as you know. And, Tommy, it's interesting how if you break down the numbers, if you dive a little deeper, it gets more interesting. Like a lot, what we talked about, leisure and hospitality, 123,000 jobs. You can basically say the whole increase, the whole beat on this number was leisure and hospitality jobs. But, Tommy, if you look at the breakdown from the size of company, small companies, right? 1 to 19 people up 65,000, 20 to 49 up 130,000, mid-size. 50 to 249 up 159,000, 250 to 499 starts to drop off, only up 32,000. Something's got to give here, right, Tommy? Large companies, larger than 500 employees, down 151,000. So here comes the layoffs at big companies, Tommy. Interesting how much of the labor force they control, but still a much stronger number than expected. And one thing to think about, Amazon's layoffs this morning, Tommy, 18,000 people. Seems like a big number, and for those people getting laid off, I'm sure it's a life-changing event. But that's 0.01% of their workforce. Now, Salesforce, yesterday, their 10%, that's 7,000 jobs, was 10% of their workforce. But Amazon has over 1.5 million employees, Tommy. And so 18,000, boy, that is a rounding error.
It sure is, man. That was a great breakdown of so much action we got this morning. And I always think about like the way you put it there, right? A number like that, and especially those companies have gained. Those companies, Amazon and some of the likes of some of the biggest companies that have added so many jobs. We're going on almost 3 years now from the pandemic, but boy, some of the numbers, I forget what Amazon was at, but I think they added like 500,000 or 700,000 jobs over the last 2 or 3 years, something that's just astronomical. Trimming the 18,000, you gave a great breakdown of the number of companies. Trying myself to understand what's going on. It's going to be interesting, and interesting is a great word, man. We got interesting all over the place this morning. How it goes forward, Kevin, because I started thinking, okay, there's going to be pockets of this economy that we all know, man, that are just running hot. Leisure and hospitality, you laid it out there, 120,000 plus jobs, I think, in that sector alone. The pay for that sector alone breakdown, I think 10-point-something% year over year versus a number that was 7% overall, so still running hot on the pay. That's going to run hot no matter what. It's going to be an influence in the economy. And then you got to the big numbers of who is adding and who is losing. And I said to myself, okay, sometimes the biggest companies out there are the ones that maybe it goes both ways, Kevin. What do you think? Because I'm trying to do the math in my own head, right? First, you have big companies. Okay, maybe they're so big it's a little bit quicker to trim the fat because you don't have the personal relationships of a smaller company. On the other side of that, sometimes the smaller companies, they got to live and die. And, if they can't pay the bills every month, what did you think of the general consensus of the big companies cutting? Is that kind of a leading indicator, you think? And there's no right answer or wrong, man. It's just all what we're thinking. But quite a difference of big companies cutting. You got the medium to small companies not there yet. Is that something that you think will play out? What did you think of that general breakdown of just such a difference, man, of the jobs added? Because I think if you take out the big companies, Kevin, it was like 386,000 jobs added for the month, which is craziness right now with everything going on.
Yeah, even in Amazon's statement yesterday, Tommy, they admitted they hired too rapidly during the pandemic. And Salesforce basically said the same thing. But, Tommy, if you think about it, the numbers that I put out, as you get to smaller and smaller companies, even 1 or 2 or 5 layoffs is a significant fraction of those companies, whereas Amazon, 18,000 is really nothing. And based on what they hired during the pandemic, boy, it's a flesh wound It's not even a flesh wound. So I think, yeah, it's certainly interesting to dive into the data and seeing that bigger companies are maybe a little quicker on the trigger to make adjustments to their business because they are so big. But, the data is what it is. Leisure and hospitality services are gaining jobs, and maybe big companies, big corporations losing jobs. And you can make out of that what you want, but the reality is right there. That frustratingly resilient part of the economy that didn't come back right after the pandemic, services, is coming back now, and that's what's making these numbers stronger than expected, Tommy.
It's going to be so cool to see how that plays out in the future, man, because I don't know if I see that slowing down anytime soon. And listen, we got a lot of data to go. Who knows with what happens with the economy? If people really feel the squeeze, then, you don't have a choice. But it is amazing how time flies. And my own perspective, Kevin, I still feel like we're not bottled up, right? But I want some more vacations, man. I want to make up for a year or two of lost time, all that stuff. I still got to make it to Disney with the kids. Haven't even made it to Disney, and I live an hour from Disney. So there's some catch up, man, even, which is remarkable coming into 2023. With that in mind, Kevin, we got a big number tomorrow morning. We got some companies already out. We got Walgreens out with their numbers. What are you guys talking about on Fast Market coming up at 12 today, Kevin?
Luck Folio is going to do a presentation on Roku, and then we're going to focus, we're in the final stages of preparing, but on companies that, remember, we're in that chasm between when earnings are over for last quarter and beginning for this past quarter. So we're probably going to look at a stock like Amazon. Remember, we talked just about Microsoft and the cloud companies and how they're struggling here with decelerating growth. So we'll look at cloud, and we'll look at Roku today, some of the streamers. So we'll focus on that. It's such an interesting part of the economy, Tommy.
Boy, Roku, man, that one, I have tried to wrap my brain around that one a few times. You want to give us a little teaser in the minute and a half we have left on Roku, man? Because I'm looking at the chart on the Thinkorswim platform, Kevin, and we're trading at prices that we traded at 5 years ago on Roku, let alone below the COVID lows, way below $500, which it almost got to twice last year. What's your take on Roku at $43, literally almost where it was 5 years ago, man?
It's interesting, Tommy. What has taken over the streamers is what you thought. Such a great area of the economy with such incredible growth now has competition. And the market has punished growth with higher interest rates. Netflix is dominating this market. How do I know that? Well, Amazon and Disney lost about $10 billion last year, and Netflix makes about $6 billion. So that Netflix moat around streaming in general and what they do is keeps getting stronger. And, the competition in this area is really starting to gobble up. So, yeah, these companies, they have to stand out. And when, Tommy, when does growth come back into favor? From when and from what price level?
Yeah, on a day that we got higher yields, higher dollar, and lower market growth stocks. Kevin, I appreciate it, man. We'll be watching at 12 o'clock today, and we'll talk to you next Tuesday, man.
Have a great day, Tommy.
You too. Folks, tune in, 12 o'clock
Building
today.
wealth
We'll be right
trading
back to
in the stock market seems impossible to most people. They think it's too volatile and risky. Most people aren't going to take the time to educate themselves on how to do it right. But you're not most people, are you? At TFNN, you'll get the guidance you need to refine your strategies and techniques to invest like a pro. Because you'll be a pro. All TFNN subscriptions, books, software, and courses are available at TFNN.com. And I'm even going to tell you how to get them for less. Use TFNN's Tiger Dollars and you'll get up to a 20% bonus on your purchase. And once you apply them to your account, Tiger Dollars are automatically used for all future or recurring charges. Tiger Dollars also never expire, are fully transferable, and are a great way to add savings to your newsletters or services. Become the investor you were born to be at TFNN.com. TFNN, educating investors.
TFNN is excited about our new software charting program, The Art of Timing the Trade Charts. In collaboration with Tom O'Brien and using his best-selling book, The Art of Timing the Trade, Your Ultimate Trading Mastery System, David White has programmed an outstanding piece of software that will complement any trader's methodology. Using this first-of-its-kind program, The Art of Timing the Trade Charts allows you to scan thousands of stocks for Fibonacci formation setups, including Gartley's, ABC's, butterflies, and much more. The Art of Timing the Trade Charts is designed to help you when scouring the markets for stocks just beginning to form the trading patterns that many investors spend days, weeks, or even months searching to find. And right now, we're offering licenses available at only $79 a month. We are so confident that you're going to love this new charting software that will even give you a 30-day unconditional money-back guarantee. Don't miss out on this incredible new piece of software. Get your copy of The Art of Timing the Trade Charts today by visiting TFNN.com.
Sharpening your skills as an investor is like getting better at playing a musical instrument. You have to practice, sure, but you also need excellent instruction from experts. At TFNN, you'll get advice and guidance from the authority in technical market analysis. And it's not just dry, tedious text either. TFNN airs live financial content streamed live on TFNN.com and TFNN's YouTube channel with Tiger TV, live every market day from 8:30 a.m. to 4 p.m. Eastern. For free. Each host is an experienced trader and gives their take on the market while taking calls and questions live from around the world. From the moment the market opens until the closing bell sounds, Tiger TV has 8 different shows with expert hosts to help you make the right moves with your money. Watch online at TFNN.com or on TFNN's YouTube channel and become the investor you were born to be. TFNN, educating investors.
This segment is brought to you by Thinkorswim. For more information, just click the Thinkorswim banner on the front page of TFNN.com.
Welcome back, folks. We got markets open, and you're looking at an S&P negative by 24 points right now. NASDAQ 100, you're off about 92. That's about 0.9%. The NASDAQ 100. S&P's right now negative by about 0.6, and you get the Dow off about 0.6. That's 200. We'll call it 175 points in the red. The Dow at 33,226. We got a caller on the line. Let's jump to our man Keith from Cedar Rapids. Keith, good morning.
Hey, good morning, Tommy. How you doing?
I'm doing good, man. How are you?
I'm great. Hey, listen, I spoke to Tom Sr. yesterday about walking through a put trade on Hershey's. And I know his opinion on the stock. I was curious what yours is. And also, when you're, and I'm pretty well new to stocks, to options. And I wanted to get an opinion as far as making a directional play as a put. Now, I guess the one question I have is, first of all, assuming that I'm right on the direction of this thing going south. Secondly, I know we have implied volatility to deal with and all that, but I was looking at, do you normally buy something at the money, in the money, deep in the money,
Sure.
or how do you decide what to do?
Well, there's so many things that go into it in terms of your market expectation, right? The one thing that I'll usually look at, Keith, is I'll pull up the implied volatility of some of the numbers, right? So how far out are you thinking of going? So we have Hershey up here. Let me just pull up real quick and go over it for the listeners. Quite a stock, man, to the upside. This thing weathered the last couple of years better than many. We hit 242 back in December, but it's been a pretty quick drop-off in terms of $20, just like that. We're trading at 223. Why has this thing? Any reason why this thing's just dropped off with the market? Because that's quite a drop-off, 10% from where we were December 9th. Just giving back some of the gains, Keith, or is there anything going on that put this on your radar?
Consolidation or anything else? I don't think there's, from what I can tell anyway. Yeah,
after quite a rise when the market was taking it on the chin, man. So
rotating into defensive,
Sure, yeah, no, for sure. Because, man, you put this thing on a 3-year weekly, folks. I mean, the start of COVID, it was at 160. You just traded to 242, and it's been a one-way trip since the beginning of last year when you were at $150. And even excuse me, that was 2 years ago. You were at $150. Last year, you started at $190. So we're still a solid $30 above where you were to start the year of 2022. So for the options, right? What I'll do is, it's really a lot to do with your risk profile, in terms of what you are really looking at. Now, first thing I'll say here is looking at these. Now, those are the January 6th ones tomorrow. They're probably very lightly traded, Keith, because I'm seeing a huge bid-ask spread, across the board on these. So are you already in these? Do you already have an option in these?
No.
Okay.
I'm using this as I'm dipping my toe into the water. It's my first,
no, that's great. So this will be a good one to go over and take a look at it. So what I'm doing? Are you watching Tiger TV? Do you have my screen?
I'm sorry, I'm not. I'm at work.
That's
right
okay.
now.
We'll walk through it either way. Don't worry. I appreciate you calling, man. So I jumped into, and you can do this, Keith, when you get in front of your screen. All right. I jumped into just the different options chains coming up. So you have first one you have the one that expires tomorrow, January 6th. Okay. I went out to January 13th just to take a look to see what kind of implied volatility we have. But here's the thing, man. These are so lightly traded, Keith, that you have bid-ask spreads in puts and calls that are huge, to put it lightly. I mean, for instance, Hershey right now is trading at 223.50, we'll call it. And looking at the 222.50 call, so that's about a buck in the money, right? You have a bid-ask on this of about $3 by $5, okay? So it's huge, and you can try and do some price discovery in there. You can, anytime you're doing this, I would put the order in on the low side, right? Because you really never know when the market is that wide where the true supply and demand intersect. I mean, you have for instance, the 222.50 call right now is 295 by 520. Well, in theory, you'd say, okay, well, the middle of that spreads at about $4, $4.10, right? Maybe that's where. But it doesn't mean it, because the biggest bid right now is 295. The biggest ask is 520. So you're looking at an options market in this equity that is super light right off the bat. So number one, you're going to have trouble getting in, and number two, you're going to have trouble getting out. And so that's really what you want to pay attention to on this, because if you get the type of move that you're looking for, right, the bid ask might eat up some of your profits in pretty dramatic fashion, man. Because you even go further out. Let's say you want to go. We'll look at the put side, okay? And let's say you want to go out of the money on a put. It's trading at about 224 right now. Hershey's is, and if you go to a 220 put, $4 lower, expiring a week from Friday. That put right now is trading at 80 cents by 310. It's a huge percentage-wise. I don't think I'd be touching them with that big of a bid-ask spread on this equity, because it's going to be very difficult for you to make up that bid-ask spread on something that's just so light right now in terms of where you are. And what's probably going on is, you look at this equity, for instance, and putting it on a daily basis. I mean, some days this equity, Keith, is only doing 400,000 shares, the whole equity. So if you have an equity that's only doing 400,000 shares, like I'm going back even December 23rd, it did 350,000, December 29th. Now it's holiday trading, all right? But I go back to, any random day, you're doing 1 million shares. And if you're doing 1 million shares of an equity, you're doing very, very light shares on the options. So that's I'd probably stay away with the puts with that type of a bid-ask spread. Now, the other side of that is you can always just try and go in and be the bid or be the ask, and see if you can get executed on that side of the bid-ask spread. But keep in mind, even if you initiate that trade, it's going to be hard to get out. And if you're paying, for a put, if you ever go out of the money, right, and you're paying, $3 to get in, and if you want to sell it, they're only going to give you 75 cents, right? That's a tough one, especially when you have a delta that's 31, and they're closing a little bit now as the market's opened, okay? And this is what happens with options. But still, that 220 put is about $1 by 235. And that's just very, very wide to be trading those. That's the bummer of it sometimes when you have it. So, yeah, that's and to your question of if you go out of the money. Man. Yeah, I appreciate it. I appreciate you calling. And the one thing to finish with, right? And there's no easy answer, Keith, man. And you're asking great questions, right? Where do you go? Do you go out of the money? Do you go at the money? So let's say that let's say that the market was not as wide here, right? And you choose an equity that does have a pretty tight bid-ask spread when it comes to options. You say, do I want to be at the money? Do I want to be out of the money? Well, you have to figure out what you're willing to risk and what you think is going to happen in that equity. Because if you go out of the money, right, all your money's lost if the stock stays flat. The good thing about buying an option sometimes slightly in the money is that you're not losing everything if it stays where it is. You know, you're still losing that premium, but it becomes a different trade where your risk versus reward is different, where if you're expecting that the stock could stay flat to go lower, well, if it stays flat and you're out of the money, you lose everything, right? But if you're just looking for a huge move in either direction and you're going to play the downside, maybe that's when you go out of the money or something like that, you know? But I wish I had a little more time, Keith. You know, give us a call back, man. I appreciate the call. Take a look at some of those options, and please give us a call back. I'm sure you're not the only one with those types of questions, man. I appreciate it.
Yeah, thanks.
Okay, take care. Folks, we'll come back with our man Teddy Kekstad. Stay tuned.
You might think that if you want to be successful at trading in the stock market, you're going to need a crystal ball. After all, it's impossible to predict the future, right? Like any endeavor in life, before you decide it's impossible, get some advice from the experts. You might find that it's not so impossible after all. For daily market overviews that give you direction on the key indices, selective stocks, and commodities, subscribe to the Opening Call newsletter at TFNN.com. The Opening Call newsletter is written by Basil Chapman, creator of the trading methodology known as the Chapman Wave. The Chapman Wave up-down sequence gives you an edge in identifying price turns, finding the peaks and valleys in stock prices. Get the Opening Call newsletter by Basil Chapman in your inbox every day. First-time subscribers also get a 30-day money-back guarantee. If you're not satisfied, let us know, and you'll get a full refund within 30 days of signing up. TFNN.com, educating investors.
The technology around us is changing every day. With so much happening, it can seem impossible to keep up with all the information. David White's investment newsletter, The Technology Insider, is designed to give you all the information you need to understand the technology that shapes today's markets and tomorrow's future. David White has made his living staying on the cutting edge of technology. His weekly newsletter will give you specific recommendations for value tech stocks, as well as entry prices, target prices, and stops to set for each trade. Dave delivers his weekly newsletters every Friday with updates throughout the week. You can get the Technology Insider at TFNN.com for only $37.50. Sign up for David's newsletter, The Technology Insider, and get an inside look at everything the technology sector has to offer. Try it risk-free today with our 30-day money-back guarantee. TFNN, educating investors.
Will the S&P 500 continue to climb? For bold trades on U.S. large-cap stocks in either direction, trade SPXL, SPUU, or SPXS. Directions Daily S&P 500 Bull and Bear Leveraged ETFs. Direction Leveraged ETFs. An investor should carefully consider a fund's investment objective, risks, charges, and expenses before investing. A fund's prospectus and summary prospectus contain this and other information about Direction shares. To obtain a fund's prospectus and summary prospectus, call 866-476-7523 or visit directioninvestments.com. A fund's prospectus and summary prospectus should be read carefully before investing. An investment in the funds is subject to risk, including the possible loss of principal. The funds are designed to be utilized only by sophisticated investors such as traders and active investors. Distributor Foreside Fund Services, LLC.
This program is brought to you by Vista Gold, traded on the NYSE American and TSX under the symbol VGZ.
Welcome back, folks. We have markets falling off right now with the S&Ps off. Look at that drop off, man. S&Ps now off 1.2%. Just like that, we give up about, what are we talking about now? 50 plus points from where we were early this morning. We're coming into the lows of the session on Tuesday, also coming into the lows of the session last Friday with the S&Ps off 1.2%. It's a good day to talk to our man, Teddy Kekstad. Folks, you can check out Teddy's Tiger Forex report under the newsletter page at TFNN.com. It comes with a great webinar Teddy did. You get it for a month. $97. You don't like it, you cancel it. I'm telling you, you'll get an education during those 30 days no matter what. Teddy Cakestad, good morning.
Good morning, Tommy.
Boy, it's always a good day when we got you on Wednesdays because we got some economic data coming down the line, but Thursdays works as well, man, because we got the ADP number. And what's your general take on the action that we have going on so far?
Well, I think it's just the market doing what the market always does. It does what it wants to do. Nothing can control the market. It can only influence the market. And when you look at the data that's been coming out, everything that the Fed's really been saying from their narrative is not really going the way they want it to. So that means they're going to keep on being hawkish. There's every reason. We've been talking about how economic numbers are going to mean a lot over where we're in the time period that we are in now. Okay. Now, if you look at them, yes, inflation seems to be cooling off as far as at the rate of acceleration, but it's still growing and it's still there. It's just not as fast as it was. Okay. So that's something that the media is saying, oh, the Fed's getting what they want. But the Fed also wants to bring on a recession, even though we're already in one. And they want to do it by having job losses and a retraction in the business world. Okay. That's not happening right now. That doesn't fit their narrative, at least totally. I heard your discussion earlier about the Amazon versus small businesses, which is a truly key point. And that's something, so in some ways they're getting what they want, but they're not getting everything they want by the data. And I think that the market, no matter what, is going by, well, if the Fed's doing what they're doing because they want to do it. The market's going to dictate what really happens, though. And pricing is showing that it doesn't matter what they want to do. The dollar's getting stronger because of weakness in other currencies, not so much because of the economic data or what the Fed is doing. But the Fed is helping to support that trend, meaning that the bond market, remember we were saying, like, did the market really turn? Did the dollar already turn? That would mean that right now we were in a corrective phase as far as strength. I don't think that's the case. I think if you look at the 30-year and the 10-year, especially the spread by the way they trade, typically the 10-year and the bonds are about basically 2-to-1 ratio. But when you see the bonds accelerating to the upside or the downside and the spread differential being about a 3-to-1 ratio as far as movement, that really shows you what is driving the market. Okay, short-term interest rates drive the interest rate market in the short run, obviously, but they don't dictate it in the long run. And when you have that kind of volatility push and momentum by the 30-year, which is not as heavily traded as the shorter terms, that tells me that the market wants to have higher yields, lower bond prices, and a higher dollar. Okay, so and it doesn't matter what the Fed what the Fed is doing right now is helping to support that by their narrative. Okay, it doesn't mean that their narrative is right and that's going to bring on the results that they want, but the market is supporting that right now. And I think you can see by the way the U.S. dollar traded this week. On Tuesday it looked like the dollar was going to be weak, and then yesterday, obviously, it was going to be stronger. Then yesterday, it looked like, okay, the holidays are over. We're not just algo trading. The economy is going the way the Fed wants it. We're going to see the dollar start to fall down. Well, the reality is that's not what's happening. You can see it by today. Like the pound is leaning on new daily lows. The euro is almost there. You have an acceleration of the U.S. dollar yen. So once again, if the dollar has topped, then this was only a corrective move. But I think that we're showing right now that it's not a correction and the real overall trend is coming back going into 2023, meaning that we're going to have a stronger dollar for the next few months.
Yeah, right as we climb above 105, man, on that dollar index. I was jumping around to the euro and the yen as you pulled it up as well. Pretty interesting. We're back above Tuesday's high after that pullback in the dollar yesterday on volatility in both directions. And it would kind of make sense, part of what, you and I have been talking about when you're coming on a weekly basis, that the data's got to get there, man. And no matter what the Fed is saying, I find it so interesting that the market seems to continue every time the Fed gives even the pause that the data may be lining up.
And yes, that's exactly it. And we talked about this already a couple of weeks ago, that into the first quarter, and also right now the Fed is doing what they're doing not because they want to. We talked a couple of weeks ago about this, that into the first quarter they're going to still remain on this hawkish thing. They're not just going to go from this strong stance to we're neutral. They're going to ease off it. Now we did say that they're not going to raise at the rate that they were doing, just like inflation isn't running at the absolute high rate that it was doing. But it doesn't mean that they're going to stop doing it. Okay, and it's not about defending the dollar. It's about fitting their narrative. And because these data points that we can't just look at the major ones saying these are slowing, inflation's slowing. There's other things that are not supporting their things, meaning they want job reduction. They want to bring on a recession. Until they get the data point quote unquote, this isn't a recession. I mean, everyone out there will tell you you're in a recession. And anyone that loses their job right now in an inflationary environment, that's not good for them. So nobody really likes what the Fed's doing, but they're going to keep doing it at least for the next few months. And that's going to be supporting the dollar as well against these other currencies.
Nice. Would you mind hanging to the break? Because I wanted to you gave quite a recap of things that could happen. Big picture, and we're going to take a break, but would you mind going over for some of the listeners? Because I was talking to my dad over the holidays about what you were potentially saying could come down the line. And if it's okay, I want to go through some of that after the break. Does that work?
Absolutely.
Okay,
for sure.
Folks, we're going to come back. Teddy's going to talk about some of the big picture things as we come into 2023. We have markets and negative prices. We got the dollar up about 69 ticks at 104.94. Stay tuned, folks. We got everything working again. We'll be right back after the break. Welcome back, folks. We have the S&Ps down about 45 points. That's off about 1.1%, trading at 38.30. We're talking to our man, Teddy Kegstad. And so, Teddy, man, you gave us such a great roundup of things, and you don't have to go through it all. But for those that weren't listening, there was some interesting, and that's the word of the hour, we'll call it, interesting things you were talking about coming into this year. If you could just give them a little teaser, whether you're talking about, what could play out, but where those kind of drive some of the things, whether it was, I remember gold we were talking about on there, some yields, markets, go for it.
Okay, well, definitely, I said the Swiss and gold were definitely long-term plays. Short-term, I would not say buy the Swiss because I do think the dollar is going to be strong going in this first quarter. But I would look in the overall long-term for the Swiss to be a buy over the next year and a half to 2 years. I think that trend is definitely going to arise. And the same thing with gold. You got to realize this whole narrative of the Fed destroying jobs to bring us into a recession. If you think about it, under the time period that we're in, this couldn't be if you want to talk about really beating up America, you're really picking the right time to do it. No one alive right now has lived during the Great Depression that happened back in the last century. They were born and grew up in the post era, but they didn't go through the Depression. And right now, the way you got to look at things is that we're coming into a potential of reliving the 1930s again, and especially with you're creating unemployment by design. Now, creating unemployment by design in a heavy inflationary environment really puts a lot of stress on the people, no matter what country you're talking about. Okay, and if this is, they're not coming out and saying that this is what we want to hurt people, but what they're doing is exactly what they're saying. We want to bring on a recession. Now, that's really not how you go about fixing an economy. Recessions happen naturally. You don't cause them by design. Okay, and I think really what you have here is the debt market is so inflated because we printed so much money that right now they're pushing the bond market, but then they have to make a choice. Do you want the bond market to explode or do you want the dollar to implode? And I think that's what's going to happen is they're pushing this hawkishness for the next next 3 to 6 months, and then what's going to happen is they're going to start to lay back, and that's when they're going to let the dollar collapse to eat up this problem with the bond market. And it's not good for stocks.
I like the talk, man.
It's good for gold, buy the Swiss, and Bitcoin too. Switzerland has one community now that accepts Bitcoin in all their